Over these next 10 minutes, I would like to introduce you to our coalbed methane gas project in Oregon, in the US, and outline the steps that we are following to deliver this 1 TCF gas project from its current status of confirming commerciality all the way through to full field development. Curzon is a relatively new company. We listed on the London Stock Exchange last October. We have a market cap of about £7 million at the moment. We are 100% owner and operator of the Coos Bay gas project. We have an estimated 273 BCF of contingent resources in this field as per third-party competent persons report. We picked up this asset out of bankruptcy from a prior operator who spent about $37 million on this asset. And they went bankrupt basically at exactly the wrong point, which puts us into the fantastic position of only having to spend about $1 million to put it into production. We have recently of the existing wells that were drilled by the prior operator have cleaned them out. These 5 wells are now operational and produce gas. And we are going forward, we are going to continue the testing of these 5 wells. We're going to add additional completions in these 5 wells that we've identified recently. We're going to drill 2 new wells and then also build all the infrastructure and tie into the pipeline for gas sales. Coalbed methane production may be some of you may be unfamiliar with coalbed methane production, but it is a very mature and established industry in the US. If you put things in perspective, the US has produced about 1.2 TCF of coalbed methane gas in 2015. That is about the same volume of gas that the UK produces in the North Sea. Why do we like this asset so much? Why did we acquire this from the prior operator? I've mentioned before that a lot of money has already been spent, and it doesn't take a lot of money now to ask the question whether this works. But the main reason why we like it so much is because we have very, very strong historic test rates that we believe are indicative that this is a viable project. If you look at the map that we have here, you can see that the prior operator has drilled 12 wells in 3 different drill sites. The area that we are exploring at the moment and to get it to production is the Westport area. We have 1 well on that site that has tested up to 68,000 cubic feet, which is not a lot of volume compared to some conventional well, but in terms of coalbed methane wells, this is what we consider a commercially viable rate. We had even higher production rates further down to the south in the Beaver Hill and Radio Hill area, where the test rates were up to 500,000 cubic feet, well above what we need for commerciality, but these were short-term tests. We know that the prior operator had issues with these wells, so we just don't know at this point whether these are long-term rates, but nevertheless it establishes gas flow over a large area of the field that we have, and again, we believe is indicative that we have a commercially viable project. We've had an excellent start since we've taken over operations of this field. As I mentioned, we have worked over and re-entered 5 wells. These wells are now producing gas. Gas volumes are sufficient to be self-sufficient in terms of energy and to run the pumps that are operating these wells. We're also putting flaring facilities in place to burn the excess gas up to the point where we have sufficient volumes to tie into the pipeline for sales. We're also working on establishing and installing the water disposal system that we need to dispose of the water that is being produced as part of our coalbed methane production, and we're putting in place the compression facilities that we need prior to tying into the pipeline. Another reason to be optimistic about our development is that the wells in their current condition only produce from about 1/2 to 2/3 of the open of the pay zones in these wells. The reason for that is that the prior operator has put isolation plugs in the wells to isolate the shallower perforations to test them separate from the better quality zones that are deeper. You can see those isolation plugs in blue. We have so far not removed these zones because we were originally concerned about wellbore integrity. After having done more work on these wells and having spoken to individuals that have originally worked on these wells, we now feel much more confident to remove these plugs, open the lower zones, and we will also add new perforated intervals that we have identified over the last few months from our geologic work. All this together will result in about doubling the perforated intervals in these wells, which again we believe will increase and accelerate the rates coming out of these wells and get us to commerciality sooner. We're taking small steps at the moment, but we're aiming big. The reason we got into this project following the strong test rates that we had seen earlier was that we have a lot of running room. Pending commerciality of this initial phase, we will quickly move on to phase 2, which will see us drilling about 58 new wells in a predefined area where we have existing infrastructure. And from there, we will then move on to a full field development, which might see us drilling over 400 wells on our lease position, which covers over 45,000 acres. If you put this in perspective, we expect a single well to deliver about $100,000 per year of free operating cash flow. If you see that you have 200 to 400 wells operational, we can see down the line that we're a company delivering between $20 and $40 million of free cash flow per year. If you put that in perspective with a £7 million market cap at the moment, I think you would agree that there's an enormous upside in our story here. If you're familiar with energy companies and oil and gas companies, you can have the most fantastic asset in the world, but it doesn't mean anything unless you can sell it at a good price. This is where we believe we have the edge over many other oil and gas companies in the US, because gas in Oregon, where we are located, has historically sold at a strong premium to the national gas price in the US. At a cost base of production of about a bit over $1 an MCF, we believe that we have fantastic well economics and at the same time a strong cushion should we go through another downturn in the industry. Our well economics extracted from the Competent Persons Report show that for about a $350,000 investment per well, we expect full cycle revenues between $1 million to $3 million, again outlining and emphasizing the strong financial strength of a successful project here. If you wrap all this up together, we are delivering, we are doing what we told the market we would do. We have delivered the first program on time and on budget. We're now adding additional completions to the existing wells to accelerate our production. We're putting all the infrastructure in place for gas sales this year. And in summary, we have a very large gas resource, costs very little to get it into production, and I believe is a quintessential gas or a resource play with a fantastic risk-reward project where it takes very little to find out whether this works, but if it does, we clearly are a fantastic investment proposition at our current market cap. So thank you very much for your time, and if you have any questions.